Well, good afternoon, and thanks for joining us in the next series of Upheaval Management. This webinar today, we are focusing on, do you use your company or your valuation as a company report card? Let's give it just maybe another minute or two to let some other attendees jump on, and then we will get started. All right, so our webinar today is hosted by myself, Amy Lasala, and Jason Tazinkowicz. We are both with Blue Sky Business Resources. But before we get, really into the nitty gritty of what we're going to talk about today, I want to share with everybody our Elevate Summit for entrepreneurs, business owners. That is happening in November. I'm going to drop a link in the chat box. Go ahead, click on that link, and you can see the full agenda for the 2-day summit that we are having. It is packed full of different sessions on how to build value in your business, how to grow your business, how to read your financials, lots of good stuff, great speakers. Again, we split it into 2 days. We had so much content we wanted to share with everybody. So it's November 18th and 19th. You can register right from the page that I dropped in the chat box there. So using your valuation as a report card. I'm not sure a lot of people are utilizing it that way right now. But before we kick it off, I want to ask a question to the audience, and put your answers in either the Q&A or the chat box. Either way, we're monitoring both of that. And as always, if you have any questions during any of the webinar, drop your questions in and we can talk about those as well. But I want to start out with this question. In your perception, what is the principal factor driving value in your business? So maybe give a minute or two to ponder on that, and then drop your answers in the chat box, and we will get back to that a little bit later in the webinar. So valuations are a concept, and the report card concept are near and dear to our hearts. I've been doing business valuations, I don't know, 7+ years. Jason's in
the beginning of time.
I know, right? I said that to someone the other day. I'm like, man, it makes me feel old. Anyway, so I do valuations on a daily basis. So this is my language, my universe right here. And I could talk for days on valuations, and Jason, we tag team on a lot of stuff too, and he can talk just as much as I can on these. But we see a lot of business owners who are waiting to have a valuation done and waiting until they're ready to sell. And not that that's a bad thing to do, because when you go to sell your business, you want to know what the value is at that point in time. So you're going to need to have a valuation done. But oftentimes I see these business owners are disappointed with the value that they get, and it doesn't meet their expectations for just what they wanted the business to be valued at, or even their retirement expectations. And then when they wait so long to have a valuation done, where they're contemplating this exit, they don't have much time to try and make any changes or adjustments to the business to put themselves in a better position. And I hate giving a valuation to someone where I know they're going to be disappointed, and it breaks my heart seeing that when there's things that are not easily sometimes, but we can put a plan in place and help change that, and the value could have had a very different outcome. So our goal today is to explore the benefits of an analysis of your business value, as well as the market trends that your business is living inside of. Uh, Exploring that early enough and often throughout the business life cycle.
Yeah, and I'd like to just kind of pick up from there. First off, let's build on the report card concept. And, when you think about report cards, you think about your children coming home and either being really happy or really afraid to talk to you. And, you think about that. And the point of a report card is where teachers can communicate with parents how the children's education is progressing. And this is a great parallel for what we're talking about today with regard to business and market assessments. It's a chance for executives and business owners to track progress and see how their organization is developing, not just internally, but compared to its peers. I can't tell you how many business owners I speak with, and I say, hey, how do you think you stack up against your peers? Where are you really crushing it, and where do your competitors actually stack up ahead of you? And most people don't know. A lot of business owners are so focused on driving their business. They're like, as long as we're growing, as long as we're turning out a good product, as long as we have good customers, I don't care what my competitor is doing. And, there's some value to that, but there's also some opportunity in taking the time to understand where the competition is, where the market is. It's not just about establishing a strategic plan, benchmarking where you are and tracking progress. It's also about providing you the opportunity to be to adjust your expectations and your strategic decision making based on what the market's doing. Sometimes you may not be looking to exit for another 5 to 10 years, but the market is so strong at the moment that you'd almost be foolish not to consider it. And so, those are some of the things that you can do if you're tracking your business value and market trends on a regular basis. So some other things that we notice is, there's a big difference in the way that business owners make strategic decisions based on what they're looking at. And what happens if you're not looking at the big picture, it's really easy to fall into some of the myopic strategic traps. And we're just going to quickly address a couple of those and talk about how a business valuation and a market analysis can provide you with a larger, big picture to keep you out of those myopic pitfalls. And some of the things that we see really commonly are, a business focusing on increasing revenue and being so single-mindedly focused on that revenue number that they end up hurting their operational efficiency or their cash flow, because all they're focused on is growing that revenue, and they're growing that revenue at such an extraordinary cost through giveaways, through spending more money on marketing and shortchanging resources to operation and production, that they're actually, it costs more per client to capture that client, and they're losing money. Another thing that we see is companies focused specifically on improving gross margin to the detriment of everything else. And the tendency, if the incentive is on that gross margin metric, then there's a trap that employees and mid-management could start cutting corners, buying cheaper resources, and allowing the quality to slip in pursuit of that gross margin, and ultimately they'll end up spending money on warranty claims or on rework. Their gross margin may be great, but their operational expenses go down or go up, and their cash flow goes down, or their revenue could be impacted negatively because of this single-minded focus. So when you're talking about business valuation and market analysis, you're talking about getting the big picture, viewing the entire business within its marketplace so that you can assess opportunities based on the risk represented in taking specific actions, and understanding when when your benchmarks, when your margins are good, and it doesn't make sense within your ecosystem to try to squeeze more out of the margin, it makes more sense to try to grow in a different way, but making sure that that growth is measured, balanced, and risk reducing at the same time.
Yeah, definitely that big picture helps for sure. Uh, I don't see any comments from our previous question, and that's okay because we have lots of examples to share. But going back to it, so the question I had asked was, in your perception, what is the principal factor driving value in your business? So after doing hundreds of valuations, I get a lot of different answers of, I would have never thought that that would have made a difference in my company's valuation. I'm like, well, that's why you hired an expert to help you do that. So one of the fun things I always joke about hearing from a previous client was, well, my buddy got 10 times. So that's what my business is worth too. I'm like, oh, okay. Well, 10 times what? And he was like, well, 10 times. That's what it was worth. I'm like, okay. Then I don't even, go down that road yet. But I'm like, well, so is your buddy in the same industry as you? Oh, no, I manufacture and he is a restaurant or something ridiculous like that. It probably would have been the other way around. But that is nowhere near an apples to apples comparison to say, yeah, he got 10 times, let's say, revenue as an example, and I'm going to get that too. That you can never go into a valuation with an expectation like that. It's not realistic. So Greg actually says key personnel is the basis of value in our company. Okay, that I definitely agree that key personnel are a huge part of growing value in your business. So thank you, Greg, for that. That's an awesome answer. Other things I've heard, Jason kind of alluded to just previously, talking about, we're focusing all this time growing our revenue, and the bigger our revenue is, the more we're worth. Well, sometimes that could be accurate. More often than not, it's not correct. But you're really focusing in one small area where the value is really built off of a lot of little things put together.
I'm going to jump in here with my personal favorite.
Yeah.
I had a client, Amy and I worked with a few years back, and when we were having our introductory exploratory conversation, he sat down, looked at us square in the face and said, I've been running this business for 40 years and I want $1 million for every year.
Oh, that was a good one.
he was doing what was he doing? 150K in seller discretionary earnings, but he wanted $40 million for his business.
Mm-hmm. Mm-hmm. And so, they come to us, and he came to us specifically to sell the company. He was ready to transition. Like, if he could have left tomorrow, that would have been awesome. You have really tall shoes to fill, or a big order to fill, when your client is telling you he wants 40 million and he's maybe worth 400,000. I don't think he was quite that.
No, it wasn't that bad. I'm being hyperbolic, but he did want 40 million and he wasn't anywhere near it.
Yeah. And then really, when they have that number in their head and they're fixated on that, and you can't share with them any reasonable way to them, I mean, you're just at an impasse at that point. How do you go beyond that? Now, had he been having regular valuations, even 2 or 3 years prior to the sale, we could have started tackling that $40 million conversation 3 years ago, told him what it was worth that day in the market, and then let's put a strategy together looking at the metrics from the valuation, and let's him make some build value in the company, working on these opportunities that came up. It could have still been a win for him, instead of a hard impasse where there was no way we were going to get on the same page with expectations if we were going to sell.
Yeah, and the unfortunate thing was, by the time he reached out to us, he was already burnt out. And when we told him what the market was going to bear for his business, it took every ounce of wind out of his sales, and the company started nosediving. And we worked with him for years to try to get him an exit, which was, a loss for him from day one. But it took us several of those years to just pick him back up and get him back to where he was when we first started talking. And that's, again, those are the types of conversations we hate to have. And that's a horrible position for everybody when, when you're set up to not even come close to the expectations of a business owner.
Right. A couple other things that have come up with some past clients was, oh yeah, my buddy got X amount, an amazing amount, much higher than what they were going to. Oh, well, who did you sell to? Oh, well, he sold to his children and then he carried 100% seller note. So he basically paid his kids to take his business. And then we've seen a poor scenario with that one as well, where the kids take over, but really don't know the ins and outs or how to run the business, or they didn't want to. The company tanks, and now the business owner got nothing in the sale because it was their seller note.
And the kids are mad because they feel like dad ripped them off.
Right.
So.
Dad, you didn't give me a good enough deal. Yeah, we've heard that one too. Well, okay, so let's refocus and talk about what do we look at when we're doing the analysis of a company. So yes, of course, we're going to take your financials. We're going to number crunch all of that fun stuff because we like spreadsheets. That's what we do. Especially Jason. Little inside joke. Sorry, guys.
I do like spreadsheets. What can I say?
I've come to find, though, that I really like them too. Okay, so things that we're looking at that represent value in your business. Your management team, which Greg pointed out for us a little bit earlier. If you are a business owner who wears 50 hats, you're doing scheduling, you're doing bidding, you are going on client calls, you are an integral part of your business. That is awesome that you have done so much for your business. But when buyers are looking at that, and an evaluator as well, that presents risk. A buyer would need to come in and learn, take all of that knowledge in your brain, put it into theirs, and probably hire a couple more people. So not only do we have to have that transfer of knowledge from you, business owner, to the new buyer, now the new buyer has to have some cash output to hire people to not wear 50 hats like you've been doing. And I'm sure those 50 hats have burnt you out as well. So having a management team in place that can take a lot of those responsibilities away from the owner and help, lost the word. Anyway, so you're not the only person that can run the business. You as a business owner should be able to walk away, take a vacation for a week, have your management team running the business, and you come back and it's like you never left. That is optimal for a business owner, and that actually will decrease your risk factor, which later on, when we're looking at the methodology of how we actually come up with that value number, that's where that risk factor comes into play and will increase the value.
Yeah, and I'm just going to interject here with the relationships too. There's an extraordinary amount of risk if your company has long-term durable client relationships or vendor relationships, but those relationships are long-term and durable because they've gotten to know you personally. They trust you as the business owner, and you are what they equate their relationship to be. There's an extraordinary amount of risk for a potential buyer to say, I can step in and I can fulfill the expectations of that relationship with the clients and not lose them because no matter how nice and good the business owner and the team they put in are, they're never going to be you.
Right.
So, that relationship risk is an extraordinary factor that frequently goes underappreciated by business owners as we start to look at a change of control as well. So the more you can have your entire team sharing relationships, the less risk involved in the customer and vendor relationships, which lower risk will always translate to higher value.
Absolutely. That was a really good segue into my next point of customer concentration. So, generally, we like to see no one customer equate for more than 15, 20 at the most percent of your total annual revenue. When you start creeping up above that 20%, that's where buyers are like, whoa, okay, let's see what's going on here. Because what if that, well, and especially in the days of COVID right now, so many businesses, have had to pivot and figure out what's going on to stay afloat. So what if you are in an industry where your top customer was 50% of your revenue and they went out of business during COVID? What does that mean for you? How do you recover that? So customer concentration is a huge part of risk and a value driver for your company. And Jason also mentioned as well, vendor concentration. That is another area where I don't think a lot of people really look at, but you can have the same issue. And my same scenario with COVID. What if you're manufacturing or making widgets and your biggest part or your parts come from one vendor and they're out of business? How do you continue to manufacture your products if you only have one supplier for that? That is I think a really hidden area that business owners don't think about, but buyers do. And really what matters in your valuation is that it's giving you a fair market value that a buyer is going to be willing to pay you for. So just keep that thought in your head too. Another area, strengths of contracts. So depending on the industry you're in, you may or may not have contracts. If it generally is not utilized, then obviously this wouldn't be pertaining to your valuation. But if you're in an industry where it's customary for you to have contracts for your clients, that's going to be somewhere we're going to dig into. We're going to look at, what is the term of the contracts? How often are you bidding or renegotiating those contracts? How long have they been a customer with you overall? And just really generally assess that. The more strength in your contracts, the less likely that customer is going to leave and bringing risk down.
Yeah, and this is a touchy subject with most business owners, because even in industries where business owners have long-term durable relationships with clients, and based on the long-term nature of their relationship, there should be a contract in place. A lot of business owners are hesitant to ask for any kind of written agreement, whether that's a memorandum of understanding or a full in-force contract. They're hesitant because they're like, our relationship is based on trust, and if I exude the impression that I don't trust my client, I'm going to lose them. And so this is something to really think about, because it's all a matter of approach. Mm-hmm. In many cases, just saying, hey, I want to make sure that we document our relationship so that there aren't any, questions down the road, especially if there's a change in management at your company. I want them to be able to step in, Mr. Client, and right away understand what they can expect of us, and have clearly defined process for moving forward together. If you present it in a way that you're really protecting them from misunderstandings or from any deviation in the expectation, then it's relatively straightforward, and it can be a big win for the customer to have a contract in place. But it starts with your own perception of why you are executing a contract and what is the value as well as the risk mitigation, and being able to present that in a clear and concise manner. And the more that you can put in place contracts, even for short-term engagements, the easier it will be to ensure that you're protected and that the client is protected. You know, I always use the mantra that anytime the expectations are assumed, both parties will ultimately end up feeling taken advantage of. And so, you know, with that mantra, getting things in writing and making sure that everybody is on the exact same page from day one will ensure better outcomes at the end, and it reduces your risk. So, you know, really keeping it in a good perspective and presenting it well is beneficial to everybody.
Yeah, absolutely. And you know, you may find a little surprise at the end of the conversation that they're like, "Oh, well, since we're talking to you, we need more stuff." And they may place more orders with you because now they're like, "Oh, well, we're talking again, we're negotiating this contract, making sure everything's right, and because we're talking so much right now, I need to give you more business." That actually happens quite often.
Mhm.
All right. Another area that we wanted to touch on are looking is looking at the marketability of your company, or the industry that you're in. So, Jason, give me an industry that would be super nichey.
We just did some work with a company doing timeshare buyouts.
Oh yeah, that was a fun one. Um, so when you are in a very niche industry, it limits your buyer pool. With the timeshare company that we were looking at, when I go in to look at other market comps or businesses, that privately held businesses that have sold in the open market, to see, you know, what they sold at, what their multiples were, when you only get a handful, two, three, that doesn't say to us that it's an active market. There are not a lot of these businesses selling. There are not a lot of buyers buying. And that one was tricky because it was hard to find really good comps, because it was so nichey. So not to say that being in a niche market is bad, because I'm not saying that at all. And it could be that these timeshare companies, you know, they're not selling because they're doing great and they are changing management internally and they're doing just fine. That absolutely could be the case. But that's one thing that we do want to go in and take a look at. So if I have a client coming to us saying, okay, I want to sell in the next year, and they are a small farmer growing garlic heads, which this is a true case, I could find zero comps. And when I did some buyer research, there was no one buying for that either. And I was like, yeah, this is probably not going to be the best place for you to go to try and sell your company. I just didn't work.
Well, and this is a double-edged sword. You know, one side, you can look at the marketability in the industry and you can see no real commercial activity. And that's information, right? We can use that information to say, okay, we're going to need to take a year or so to develop a strategic marketing plan to target the competitors that you have and position your business to be the type of company that they need to buy, either because you've become such a thorn in their side and such a competitor in their marketplace that they have to buy you to relieve the stress you're causing, or you've become so dominant in your marketplace that their only chance to grow is to buy you. So, you know, understanding a non-active industry just means that it's going to take a different strategy and more time to position you for that strong exit. The other thing that we see a lot is when we're working with businesses on an annual basis, reviewing their report card, we can pinpoint, you know, in 2017, the safety controls technology environment became really, really hot. I mean, it went crazy for 9 months. And so if we were working with a safety control technology company, we could say, hey, you know what? I know that you didn't plan on exiting for another 5 years, but right now the company is the industry is booming and you're never going to find a better time to sell. Let's look at that. So looking at the industry activity and the marketability, especially on an annual basis, provides you with the insight you need to time your exit. And as any business owner knows, timing is key.
Absolutely. Not that we see this part so much, but if you're in a very mature industry as well, and you're looking to sell, and I'm thinking more on like obsolescence on that side of the mature industry, that could potentially be an area of where the market's not buying, other technology has already surpassed you. So I mean, that's things you should be aware of too, where if you're in a high technology type company and we're doing valuations for you every so often, I mean, that can be an indicator, when we're updating the valuations, if maybe we're seeing revenue start to slide, or we're seeing gross profit dipping. That could be an indication like, okay, you need to start getting back ahead of this technology if you're staying stagnant, because you're not building value, you're going to start diving. And that can be seen if we're doing regular valuations. So, I mean, we've kind of touched on all of this stuff going through, but how does this translate into a report card for your business? So by understanding the things that are impacting your value strongly, either positively or negatively, you can understand where the value drivers are in your company and what you need to do to take advantage of those opportunities. You have that better picture of how to build value. And what I just mentioned, actually, what is the biggest impact? You could do evaluation. We could identify, say, 3 areas of opportunity for you, but one of the 3 might have the biggest impact. And so obviously you want to put a strategy together to start working on that opportunity first. I mean, that just makes common sense there. Let's get the biggest one out of the way first, and see that increase, and then start improving on the other areas. Another thing too is, if you do an annual valuation, a lot could change in a year, within your company, within your management team, within your industry, the products you're selling, whatever that may be. And a year later, the priorities could be entirely different. So just to say to have one done 1 year and then you're waiting again 3 years till you sell, I mean, that's a whole lot of time in there where so many different variables can change. And your report card could be totally different year to year. Another thing I see a lot, and I hear business owners talking about a lot, is they work so hard in the business, building it and making it successful and helping their employees be successful. But then they don't understand where the areas of opportunity are. They're like, I'm there every day. I don't see any way we can improve or change anything. Well, so having a third party do a valuation for you, where I'm truly looking from the outside in, I can see that big picture of the whole company. Whereas when those business owners are so entrenched working inside the business, that they sometimes can't see it. So that's another great reason of why to do evaluation frequently, because then you can really step back and say, okay, my accountant said this, the valuation expert is saying this, maybe my attorney has said it. I think I'm starting to see where they're leading me, and it makes sense. Generally what we see, a lot of the other trusted advisors that they're working with have seen as well. And it always helps having, a couple of different people saying the same thing.
Yeah, and if I could jump in on that one too, you know, another problem that business owners frequently have is if they have a good core of trusted advisors, then they have people that are in their ear telling them things, but there's no guarantee that each of their advisors is driving in the same direction. You know, I've worked with a lot of companies where the accountant's expectation of the business owner's future is different from the financial advisor's expectation, and both of those are different from their legal counsel's expectations. So they're getting good sound advice from three different trusted advisors, but that advice, because they're all working in their own silo, is pulling the business owner in three different directions. And you know, another thing that this process does is help align the advisors so that we're all looking at the goals of the business owner and providing coherent advice and guidance to achieve those expectations, instead of making assumptions of what the business owner needs and giving advice based on our own siloed expertise.
Right. Well, and Jason and I specifically have run into that problem. That we gave a valuation to one of our clients, and we had butt heads a little bit with the CPA and couldn't get on common ground. And we were both wanting the business owner to be successful, but it was an awkward situation when the CPA tells you in front of the client, you're just wrong, because he was not willing to hear a different perspective of what was going on. And we ultimately, it worked out. The business owner, you know, we got the sale through and everything. But we sat down with the CPA later, because we were continuing our relationship with them, and said, you know, let's talk through why we had differences here. Because there's common ground. We all know we can get there. And you explain your thoughts behind this, and then let us do it. And we came together and it worked out. But when you're in that silo as a trusted advisor, and you're not hearing other people's perspectives, it does make it difficult, because we're not all aligned. And in the sale process, you are bringing your attorney, your CPA, your financial advisor together. And when they're all not working in concert, it makes a very stressful situation for that business owner when they're already overwhelmed. So, okay. Let me just check my notes, see what else we're missing here. So another thing we've heard from business owners is, you know, the second they hear the word valuation, they're like, nope, stop. I'm not selling my business. And I hope by now, you know, we're 40 minutes into our conversation. I hope that you're hearing at least our thoughts as to why a valuation is so much more than just that fair market value number at the end. Jason is going to talk to us about some of the different practical applications of how you can use a valuation other than for a sale.
Yeah, and so, you know, I mean, we look at ourselves as a full life cycle partner. And you know, with Blue Sky Business Resources, we have a lot of tools at our disposal to support you know, consultation through early stage startup, business plan development, and capital raising, all the way through, you know, the ultimate exit of the business. But right now, what we really want to talk about is leveraging a market and business value analysis to help strategically plan. And there are different ways that this matters at different points in the life cycle. So if you think about an early stage company, you know, Greg, you hit the nail on the head. From day one, a lot of business owners and entrepreneurs who are looking to start a business have an idea. They have a product that solves a problem, and they convince themselves that this product, this idea, is the entire intrinsic value. It's the intellectual property. It is the business, right? But the reality is, when you're starting a business, it's the management team and the leadership that is going to bring that product to the market successfully ensure that it's a quality product, ensure that it's priced well, ensure that it's placed well, and ensure that the infrastructure is there to support growth. That's where the value of a business is at the early stage. So, working with startups and early stage companies in understanding, the paradigm of where is their value, how can they maximize that value so that they don't have to give up a lot of money to angels or seed funders before their business is bankable, before they can get conventional money. So, understanding those things and understanding how much of your company you have to give up for the capital that you need, how to time capital raises and funding rounds so that you can grow successfully and give away as little of your equity as possible through those stages. Those are critical considerations for an early stage company, and that's what this type of analysis can help them understand. It will also help them time when do you make that transition from asking for venture or seed money to going to banks, taking your business plan to a bank and looking for conventional financing that doesn't cost you equity. It also helps to identify, are there more non-traditional options for raising capital, whether that's a convertible note or some other non-conventional funding methodology. So that's early stage. Once you get into the rapid growth phase, understanding your business value, understanding your benchmarks, understanding your core drivers will give you as a business owner the power to be proactive to market conditions. It will help you understand, how do you finance cash flow in the early stages of growth? What are your expectations for capital expenditures, and how do you time those out so that you're not over leveraging the business in its early stages of rapid growth? And how are you leveraging and capitalizing on that growth to strengthen your business for the next phases? Do you understand and are you properly evaluating cost of client acquisition so that, again, you're mapping out that growth based on cash flow? Cost of human capital, the same thing. Do you know what milestones you're going to start adding workforce? Do you know where your capacity lies and how you're going to cross and plan for those expenditure thresholds of human capital, of capital expenditure, of new marketing and sales efforts based on your rapid growth? Understanding the key benchmarks of your valuation will help to drive that strategic decision making. Once you get past the rapid growth phase, you're a more mature company and you start getting into declining growth, then you can use this analysis to help understand, where are your plateaus? How quickly can you recognize them so that you're, again, proactive instead of reactive to them? What is your best strategy for overcoming that declining growth and continuing to accelerate? Is it new product launches? Is it going to be new marketing efforts? Is it going to be attacking new geographies? Or are you best served to grow through acquisition now that you have some war chest to go out and spend money with? Understanding where you're at, understanding the risk analysis attributable to all those different efforts, and being able to look at it holistically will help to guide that decision making. And then, ultimately, when you're looking at a change of control, you could be prepared, like we said, to capitalize on strong market conditions, to prepare estate planning and tax strategies so that you can put as much of that business value that you've built into your pocket, and also defining, who is the best buyer? What are your concerns? If you're looking at maintaining your workforce in your region, maintaining the legacy of your brand, you're going to go at it with a different exit strategy than if you're looking on putting as much cash in your pocket as possible. So understanding all of those things early and positioning your business for the best possible exit is another thing that, having this annual report card will help you do. And ultimately, the point we're trying to drive home here, and what I think the horse I think we've kicked for a long time is, if by the time you've made the decision that you're looking to get out of your business, whether that's a retirement, whether it's burnout, whether it's just, what, it's time. If you don't know what your business is worth and you don't know how you're going to exit, you're already a little bit behind the eight ball. But if you have a team of people that you trust to facilitate that transition, if you know what to expect from that transition, and your team understands what success looks like to you, then we're all going to be in a great place to hit the ground running and to execute and drive the best possible outcome based on your expectations for you.
Yeah, absolutely. Absolutely. I do want to say one little antidote on the estate planning side of things. We worked with a number of financial advisors that before we started doing valuations for them, the business owner was just giving them a number. Yeah, I think right now the business is worth 10 million. Had absolutely no documentation behind that, other than it was just his gut feeling. And so the financial advisor does this whole intricate retirement strategy with the $10 million valuation of the business, which usually is the largest asset in that retirement strategy. So if you are putting this whole plan together on something that you truly don't even have an accurate value for, your whole retirement strategy is useless. Especially, it breaks my heart when the value is significantly less than what they've been using in that retirement strategy, and they're close to retiring, and now they think they can't. And expectations have to change, and whatever that lifestyle that they wanted to retire with is now different. They can't send grandkids to college or whatever they wanted to do. They now think they can't do that. That breaks my heart. And we have a way to help them prevent that from happening, and giving them realistic numbers and putting that in.
Yeah, we do have a comment in here, and it's a good one. It's talking about understanding the life cycle of the industry. We've talked a lot about the business life cycle, and we've talked a lot about comparing it to the market. But one of the things that that Brian has been good enough to bring up that we haven't mentioned is, sometimes through the life cycle of your industry, the market changes. And his comment is that as some industries mature, the products and services become commoditized, and then you don't have as much leeway in growth potential and pricing potential in transaction structure, and that could dramatically reduce the overall value of your business, because again, anybody that's going to buy a business is buying that business as an investment, and they need to see that investment grow. If they're buying it with their own money, they're trying to make their money work harder than it can in the stock exchange or in financing. If they're buying it as a private equity firm, they're looking for a return that they can give to their funding partners, as well as to grow their private equity firm. If it's a strategic company, obviously they're looking for some synergies where they can cut costs right off the bottom, but they're still looking at that acquisition as a way to grow their business. And so once you get into that commoditized space, your revenue and cash flow are going to no longer be the key value drivers. Your placement in the market, your market capitalization, maybe your processes and systems, or the leadership team that you have in place that could provide instant growth to a strategic partner by pulling those systems into their platform company and optimizing the overall company. Those are the considerations that start becoming key to your business value. And so understanding what metrics are driving value for your business in your industry at the given stage of the business and industry life cycle are going to be imperative. And like Amy alluded to, and as Brian's comments so keenly points out, those change over time. So it's It's never going to be good enough to take one snapshot in time and say, okay, now I understand, and I'll work around that, because things change. The picture changes every year. And so, again, having some way to have third-party validation of what you believe your business is doing, having some outside guidance as to what the bigger picture of your business and your industry are, and helping you to identify opportunities and prioritize them so that you are a leader of your business, not a firefighter within your business. Those are all key opportunities that are facilitated by getting an annual report card.
I do think too that something a little unique with Blue Sky doing both, well, lots of different services, that we can help businesses with, but doing both valuations and sell side engagements. Um, Even though as the evaluator, I can see when there is a really active market when I'm looking at comps that have sold. I also have the rest of my team in the back of my ear telling me stuff all the time about how Jason mentioned that one segment of the market was really hot for like 9 months. Well, like he said, we can reach out to those clients that we're working with and saying, hey, something's going on here. Let's update your valuation today and let's have a conversation and see if it makes sense. Like even if you weren't looking to sell right now, but you never know. But if you aren't working with a valuation firm or you're not doing these things on a regular basis, as a business owner, I can't imagine that some of those subtle clues and changes in the market that you would be that attuned to and would be able to capture the opportunity like you would working with someone like a Blue Sky.
Yeah, and the last thing that I'm going to say about valuations as an annual report card are not all business valuations are created equally. So I think that it's important to have at least a short checklist of things that you ask any valuation or analysis firm before you engage with them, and those things are, first off, how do you determine value? And there are a lot of recognized and industry accepted best practices with regard to valuation. But the first rule of business valuation is there is no one methodology that fits all businesses. So, first and foremost, look for a company that uses multiple methodologies and chooses the most appropriate based on the business scenario to determine that value. Anybody that is using one or two methodologies is not going to give you the comprehensive information to drive the strategies that we're talking about. The second is to make sure that the valuation firm is giving you benchmarking and industry comparable data and industry life cycle data so that, again, you can put this all into context. Mm-hmm. The third is, are they looking at your organization from a structural standpoint? Are they looking at concentration, vendor and customer? Are they looking at cost structure? Are they giving you the comprehensive information that you need above and beyond end of day value in the fair market so that you can actually make strategic decisions? And so, just understand that there are a lot of firms out there looking at businesses. A lot of accountants will say that they can give you a valuation, and there's nothing wrong with the numbers that they're giving you. But there's a big difference between somebody that says, well, right now you're going to be worth about a 3.5 multiple on your cash flow, and a company that says, okay, what we're seeing right now is that your risk is at about a 20%, and that's going to translate into a 3.5 multiple. And those numbers might not be right, so don't quote me on those. I'm coming off the top of my head, but that risk is going to translate into this multiple of cash flow. And here's how you compare to your industry peers. Here's where we see the industry going in the next 5 to 10 years. And these are the things that I would really be focused on inside your business to mitigate risk, mm-hmm. to strengthen durability, and to position yourself as a leader within that marketplace. And so again, this isn't a commercial for Blue Sky. This is an informative webinar for getting information that you as a business leader need to drive your business forward, to ensure your outcomes throughout life, and just make sure that you're diligent in who you get to provide this information on an annual basis, and get somebody that you can trust. Make sure that the company has integrity and that they're going to be giving you information that you need, not information that they can upsell from. Those would be the key takeaways that I would want to make sure that anybody has when it comes to looking at business and market valuations for strategic planning.
Well, and one other thing I want to say as well, that when you're looking at a company to decide if they're going to do a valuation for you, is if they're asking you what you want up front before doing any analysis, and then surprisingly that's what they come up with, I would be a little skeptical on how much analysis they're actually doing and looking at your company versus what they think someone in your industry should be doing. So.
Yeah, and to be clear, business valuation is a little bit art and a lot of analytics. So there's always room to nudge numbers in the direction you want them to be, right, if you're not diligent. And just make sure that you understand, whoever you work with, the why behind the risk that they attribute, and make sure that it makes sense. One of the things that I get really excited about when I'm talking about business valuations and analysis is that I get to learn about these businesses, and by reading the financials and by looking at the narrative that we get from our interviews, we should have a very clear story. And I know that my valuation is good when I'm sitting down with the business owner and telling them what's happening on the front line, and their eyes get real big and they're like, how do you know that from, a couple spreadsheets? That's the level of understanding and the depth of knowledge that you should receive when you're getting this annual report card. Somebody from an arm's length being able to characterize what's going on day to day in your business is going to be giving you a good, reasonable analysis of your business, because they've taken the time to understand it. Absolutely. And as long as your valuation team can do that, then you're on a good page, and you can trust it, and you can make strategic plans from it.
Yeah. Well, we are at the end of our hour today already. Thanks, Jason, for joining me on our webinar today. And don't forget, click the link. I dropped it again into the chat box because I had it only to panelists the first time. So everybody else can see it now too. It's elevate-biz.com. We are super excited to be having this 2-day summit. It is virtual, fully interactive. You will get live streaming video from all of the speakers that are coming on. We have an amazing keynote speaker, Jennifer Fondervey. So excited to hear her talk at the end of the 2 days. So check it out. Right now, early bird pricing is going on through October 19th. It will end. Prices will go up a little bit after that. So grab your seat before the 19th, and we hope to see you at Elevate. Thanks, everybody.
Yeah, thanks so much, guys. Have a great day.